Welcome back to the deep dive. Today we're tackling something I think many of us have run into, that mystery around mutual fund returns. You see a fund advertised, maybe it says 15% return, something really great, but then you look at your own statement and, well, maybe you're only seeing 13%, maybe less. It's a bit of a head scratcher. So our mission today, let's try and pull back the curtain on why this happens and maybe figure out what really matters when we're looking at these funds beyond just that, headline number.
Yeah, and what's fascinating here is it's not just random. There are really specific reasons for that gap. It often comes down to things like, well, exactly when you put your money in or maybe took it out. Plus, you've got charges like entry or exit fees and those ongoing expense deductions. You see, the return in the brochure, that's usually historical, kind of averaged out.
Yeah.
Your personal return. That depends entirely on your specific timing and how you interacted with the fund.
Okay, so timing is a big piece of it. Like if I invested right before a dip.
Exactly. If you put in a lump sum just before the market corrected, well, your initial return might even be negative for a bit. Even if the fund's advertised average for that year looks positive, that average smooths things out. But your entry point, that sets your immediate experience. It's very personal.
Right, right. Makes sense. So timing. What else chips away at that advertised number?
Well, beyond the timing, you've got those fees and charges we mentioned. Think about entry or exit loads. They can take a chunk right off the top or when you sell. But the one that often has a bigger, quieter impact over time is the expense ratio.
Ah, the expense ratio. That's the annual one, right?
Yes, exactly. It's not a one-off. It's a percentage taken out every year from the fund's assets. Covers management, admin costs, all that operational stuff.
Okay, but it often seems like such a tiny percentage. Does it really make that much difference?
Oh, it absolutely can. It might seem small, like 1% or 1.5%, but don't underestimate compounding. Let me give you a quick example. Imagine two funds, right? Both return, say, 8% on paper. Fund A has a 0.5% expense ratio. Fund B has 1.5%, that 1% difference. Over 20 years, even on just an initial 10 grand, that can cost you tens of thousands in lost returns.
Wow. Okay, that really puts it into perspective. Tens of thousands.
Because that money is taken out before it gets reinvested or compounded for you, it's gone. And it happens kind of behind the scenes, reducing your actual take-home amount.
Okay, so that helps explain the why our numbers might look different. So the next question is, what should we be focusing on then, if not just that big return number? Because, for a lot of people, that advertised return is the main thing they look at. Are we making it too complex, talking about all this other stuff?
That's a fair point, but connecting this to the bigger picture, I'd say looking only at raw returns is actually insufficient, maybe even risky. Understanding these other factors isn't about overcomplicating it. It's about making, well, smarter choices. You might see two funds with the same historical return, let's say 12%. But Fund A got there with wild swings, big ups and downs. Fund B was much steadier. The better choice usually is the one with lower volatility, more consistency, and smaller drawdowns.
Okay, drawdowns. Can you unpack that a bit? What does that mean exactly?
Sure. So a drawdown is basically how much a fund falls from its highest point during a market downturn, and importantly, how quickly it bounces back. It's a measure of resilience, how much pain you might feel as an investor. And this is why we talk about risk-adjusted return. It's not just how much did it make.
Right.
It's how efficiently did it make that return, considering the risks and bumps along the way. Think about it. Fund A gets 15% but drops 40% one year. Fund B gets 13% but maybe never drops more than 10%. It recovers fast. Which one feels better? Which one actually preserved your capital better during stress?
Yeah. Okay, the second one sounds a lot less stressful.
Exactly. So focusing on that risk-adjusted view emphasizes stability, consistency through different markets, bull and bear. It tells you more about how the fund manages risk, not just how high it flew when times were good.
Okay. This gives us a lot to think about. So what does this all mean for you, the listener, looking at your own investments? How will you maybe assess things differently now, moving beyond just that single advertised return number? Maybe start considering these deeper things, the risk, the stability, the consistency. Perhaps the question isn't just, what did my fund return, but also, how bumpy was the ride to get that return, and how well does it hold up when things get tough?
Yeah.
It's about understanding the whole story, doesn't it? Not just the highlight reel. And choosing investments that really fit your comfort level and your long-term goals. Really building sustainable wealth, not just chasing a number.